Hi guys, once again this is Alfred from Amassers.com. I've had some guys to ask me questions about the deviation levels. I've been sharing deviation levels for ES now for a couple of years, but lately I've been sharing Bitcoin deviation levels, so I wanted to talk about some use cases for that and really share a little ideas about how to use them for a little statistical arbitrage. You gotta remember, when we're all just little retail traders and we're out here trading or trying to build our little crypto position against professionals. And one thing that the guy at Wall Street Bet said that I completely agree with is, you're on this side and you're lonely and over on the other side there are a lot of professionals that are working together in a unit. Some guys that are good with the math, some guys that are more experienced, some guys that are there to coordinate everything. And so it's great when communities come together, and I try to do my little part to help out in that spirit. So that's really why we've been doing a lot of the deviations, and I've been sharing some of my ideas on Twitter. So let's just get right into this and get you guys some information that's going to hopefully make the deviation levels a lot easier to understand and give you some good use cases on how to implement them into your trading. Usually what I will do is it needs to be after 6 p.m. Central Standard Time for me to post the deviation levels. So at that time, my brother made this program which goes and collects data from investing.com. That's why I'm always saying that the data is from investing.com. What's the significance of that? When you see the numbers, because there's no centralized numbers, when you see a number on a deviation level and you're trying to look on whatever broker or whatever platform you're buying on, there may be a difference in price. So you can go and look on investing.com and you can synchronize the numbers that are there in the deviation levels by the numbers that are there in real time on investing.com. So I'll usually come over here, and after I've updated my data at the end of the day, I'll do this command line approach. This is a command line. Some people may not remember this, but back in the day there was DOS and everything was command line. Probably giving away my age a lot there, but I'll just do the command. We'll say what symbol are we referencing, and BTC. Oops, I screwed it up. Okay, no. What program are we using? Index.js, DWP. The symbol. And this will go through, collect the data, and give me my deviation levels for that day. Remember, always look at the day, because if I'm tweeting these this late, I may quote the wrong day. But this part here, I'm just copy pasting into a little infographic, and it'll always give you the right day, even if I screw up, because this is the part that's not human. Once I've got those, I take it and move it to a prettier version, I think, which is what ends up being posted here on Twitter. Now let's talk about the levels and a little bit about statistical arbitrage. I don't do that battle thing between indicators and price action and fundamentals, TA, statistical arbitrage. To me, when I stop warring like technical analysis versus fundamentals, and I try to implement both of those approaches into my trading, I think it helped a lot. But most people just overlook fundamentals. I want to talk more about fundamentals this year on my channel. I've just been a little under the weather this year and so busy with all of the stuff of my other business that I just haven't really had the time. I didn't anticipate being under the weather this much. But fundamentals and TA, they don't have to war against each other. That's all I'm getting at there. What is a deviation? It's an expected move based on historical volatility in for that day. So if we only move, let's say we set a top halfway or half deviation, what's most likely is this a day where the bulls are out and they're running everything? If we can't get past half deviation, probably it's not a day where the bulls are running everything. It's more of a bearish day. There are a lot of other things you can look at, but this is done a real simple way that I would use deviation levels. I'll especially use this if I'm trading Forex, like I'm trading Euro, USD, or something like that, and I know the first 3 hours of the London market are over, and we haven't broken a half deviation. That's a cue to me that the bulls are probably not running that day. You know, it's the bears. It's the bears' day, at least for that day. But we also have probability numbers. This is the deviation level. They're denoted in halves. I just took this up to 4. What will get some guys about deviation is, oh, well, the market can run past these levels and these levels don't mean anything. And when you put out of your mind that any statistics, any data is going to be perfect and you can accept that, because the real question isn't, is it perfect? The real question is there a way for you to use it to improve your trading? Can it help you to understand what you're seeing in the market better so that you can stay more calm? I.e., the market's been showing some super volatility to the downside, but when you see all of these numbers and you see, you know what, there's a 5.7% chance that we could get all the way down here to 40,000. Then when you get to 40,000, you know, you may still be maybe not in the most chipper mood, but it won't be such an amazing shock to you, because at the top of the day you already saw the numbers and you can use that to help yourself psychologically. That's another use case for the levels. I like to, on a day when I'm looking to buy some more Bitcoin to hodl, or I'm looking to take a little off the top and use that, maybe 10% of it, to trade with, actively trying to use that to increase my total holdings. I like to use these levels as targets. Now, this level right here is +1, and you can see that number is 51,366. And let's go over here to investing. This is investing.com/crypto. That's where they have all these crypto currencies at. I'm gonna go in here to Bitcoin. I love the transparency that's here inside of the crypto space. You can really get a bird's eye view of what's going on. The low of the day is 47,031 and 51,311. And remember, our number was 51,366 for +1. Again, it's not going to be perfect. Sometimes it's not even going to be this close. But if you were buying and you were in a position and you get to that +1, that might be your target. That might be where you sell and exit that position with your profits. That's another use case. Now, if we only hit the +1 on the day and we stop there, is there, are the bulls running thing? Probably not. Not like the bears ran for the last couple of days as I'm recording this. But it just tells you there's a little bit above average move in a bullish section today, and this was kind of just that bounce off of those extremes that we have been seeing prior. So that's another use case for the deviation levels. I'm looking at the probabilities also, because if I'm selling, I want to be selling somewhere that is not very probable, according to statistics, for us to go higher than on that day. And again, these numbers are calculated every day. So after the day, I need a new set of numbers. If I'm buying, I want to buy. I actually start buying when I see we're starting to enter some territory that's kind of, statistically based on these percentages, not as probable. So maybe 2.5 here, we've got 21%. I might start buying there. And what I mean by start buying is, instead of trying to be perfect, and you can do this if this is what you want to do. If you want to say, okay, I've got $1,000, I want to buy some Bitcoin today. Not financial advice, but I'm going to share with you what I do. If I've got $1,000, I want to buy some Bitcoin today. I may start here at 200. I might put $200 down here, and I might wait till we get to this level or till we get to this level, and then I may either put 4, or I might wait till we get to the next half and put another, instead of 2, I put 4, and wait till we get another level. Now we're 1.5 below where I started at, or maybe even 2 below where I started at, and I'll put my remaining 6, and then I'm through buying for that day. And what this does for me is it stops me from having to be so perfect, so there's not the emotional tension there, is I'm sizing into a trade, and it's going to help me through the dollar cost averaging to position myself where I've gotten into, whether it's Bitcoin or Doge or whatever, where I've gotten in at a level that I know is statistically probable that at some point in the next maybe a few weeks, maybe a month, I'm going to be able to sell out of that position with profits. I started getting into the Dogecoin, just using Doge as an example, around 0.7 of a penny. And when that big run was happening, we were selling out of Doge a little, pinching our way out at like 3 cents, and then we went up to 5, and then we sold some more at 8. And I kept a little. If I remember right, I probably sold 80% of all that I had been pinching and acquiring by the time we got to 8. And I was doing that in a few days. So that was, it took me some while to get there. But when you're doing it that way, sizing in and sizing out of a position, you don't have to worry so much about being super trader. That's what I'm getting at there. So that's really about all that I had to cover on how to use some ideas of how to interpret and how to use the deviation levels. I like to use the deviation levels along with my little fear index that we made here. This is similar to the VIX, so it works like if this line is high, then there's more fear in the market. As this goes down, there's going to be less fear in the markets, just like the VIX. And I use this to help me too, because I'll do like the old guys say. I might be one of the old guys, so no offense if that's your interpretation. I'll just, when the VIX is high, it's time to buy, and you see that huge wick there for those who love price action. And again, I don't war with it. I use all of the knowledge that I have. I see this big wick here. That's a really nice wick. That's a huge level here. 1, 2, 3, 4. We're like 5 up. I know there's one. When we were there, this would have been a red candle, and I would know, okay, and this is beyond the 4 deviation. So that would be a good place to get in and make my buy. In a few hours, if I were just trading, I could have left. But I also know, and this is what turns people off, I think, when they're, even if you're doing this with the VIX, all of these levels say I'm in a fear zone. There's fear in the market, right? So if the market turns and it starts going back that way, I'm going to still be saying things like, if I'm commenting on sentiment on Twitter, I'll probably be saying there's still fear in the market. And that means that we could still have a resurgence, and we could go, we'll see how we got there, and then we started riding right back up those levels. Is the fear increased in the market, took another nosedive down, and then today we start dipping down, and the market got up here about to 1. Now there's a little bit more fear coming in. This indicator is really pretty dynamic. I use it more for like intraday trading or weekly swings. But I know when I'm in a fear section, I'm looking to buy pullbacks based on that sentiment. And when we're in a greed section, I'm looking to sell really big, strong, bullish moves. So that's really, I think, about all I can share. These numbers don't match the numbers that I post, because these numbers, this is MT4 and these are based on the data here in MT4, and it's only going to be based on 5-day data as opposed to 7-day data, which is what I post when I'm posting on Twitter. That's why my brother made this other program for me to use to gather the 7-day data for about the last 2.5 months on investing.com. That's all, guys. Once again, this is Alfred from Amassers.com. If we've helped you, please help us by sharing this content with others. Like, share, comment, subscribe. I'll see you guys on the next video.